Good afternoon, folks. Welcome to another Wednesday webinar. It is Wednesday, August 29th, 12:30 p.m. Frank is with us, but he's still a little bit under the weather. Those of you who were here last week know that he was starting to come down with something, and it's still sort of bothering him. So he'll be here in the background, and if we start talking about weed stocks or something else, I'm sure he'll join in. But for now, he'll just kind of watch. I want to thank those of you that are attending. I appreciate the attendance. We're going to do the usual. We're going to go ahead and take a look at the S&P 500, the NASDAQ Composite, the Russell 2000, and the Dow Jones. Before I do that, though, I do want to point out that I am Stock Darts, Rob, as you may know me, and you can find me on Twitter with the handle Stock Darts. You could find me on YouTube under Stock Darts, or you could find me on patreon.com/Stock Darts as well. A lot of Stock Darts. And then Frank is Stock Guy 22. You can also find him on YouTube, and you will soon find him again once we are able to relaunch StockGuy22.com, which is hopefully coming in the very near future. Hi, Ellipsis. Thank you for joining. Glad to see you are back and trading more actively. Welcome, Ron, Stephanie, which I think is new, and then Blackhawk, which is also joining us. Thank you, guys. Glad to see you in here. And so, as usual, like I said, we're going to go ahead and cover the four major market ETFs. Then we're going to take a look at the U.S. dollar, oil, gold, silver real quick. And then from there, we'll move on to the chart requests. If any of you guys have chart requests, feel free to put them in there. I'd love to see what you guys are looking at. I'd love to see if you guys are finding good trades here, right? We've had a very good last couple of weeks, and the market has provided us with a lot of good trades. It's been interesting because over the last 2 or 3 days, it's been a little bit more difficult to find good trades because the market has been sort of stretched out already and overbought, and it's been tough finding some good risk-reward plays. Those of you that are members of my patreon.com subscription will have had some really good trades, right? We've had a really good run over the last month or so. Those of you that are new or maybe haven't visited there yet, you head on over to patreon.com/StockDarts. I have quite a bit of material that I post on there. Some of it is free, some of it is subscription. The lowest subscription tier is $8 for the month, which for the price of lunch, I think is well worth it when you consider some of the trades that we've had in the recent past. I'm just going to quickly delve into a couple of them just to show you guys the strength that we've seen across the market as the market has gone up. So Jaron is one that we've had that has done extremely well for us over the course of the last 2 or 3 weeks. As you can see here, it's almost doubled in price from our entry point. We had ETP, which was a huge winner for us and has done really well. UNH has been a very steady gainer for us. Really almost no doubts on it as it's continued its climb above. MasterCard is one that we've entered recently, and as you can see, has done really well over the last 4 or 5 days. This is one BIB Biogen that we entered just a couple days ago, and it's off to a good start. Viking Therapeutics has done really well for us, as you can see, with a strong move today. Got HCP that's rebounding and doing well again. Yeah, the list goes on. These are all names. Most of them have been on the $8 subscription service. A lot of them have been on the free one. We even had free videos on Google and Microsoft and Facebook, and Google and Microsoft have done really well based off of that. NetApp has done well. So these are all chart reads, Ellipsis. This has nothing to do with saying options or stocks. These are all chart reads, and then the trader could decide whether they want to take it with options or with stocks. It's basically giving good chart reads and explaining where the entry would be and what we're looking for as far as a target is concerned. It's basically stuff that you see here all the time that I give out for free. Just I'm giving exposure to my ideas and what charts I'm watching, as opposed to just the normal thing that we do on Wednesdays, which is go over the S&P 500 and then I'll tell you from there. Typically how we work is you guys know, is we'll look at the S&P 500 and I'll tell you what I think the markets are doing and what I'm doing personally as far as tailoring my trading towards what environment we're in, right? That's why we go ahead and review the markets. And what I've done recently, a lot of people ask me for for charts, right? They're asking me what stocks I'm looking at, and sometimes I like to share it on here. But I decided what I want to do is find a new platform where I can share more of my trade ideas with you guys and more of what I'm doing. So I figured that that'd be a good way of doing it, particularly with the problems that we had a couple of times recently with our website. So I feel like it's working out. We've had a tremendous amount of trades. Those trades that I just pointed out. That's just stuff that we've looked at over the last two weeks, maybe 3 weeks. Over the last month and a half now since I launched it, we've had way more winners than that. Almost every trade we've taken has done really well. So, I think the me posting it on there has forced me to look for better trades as well. So it's helped out my trading. I've had a really good last couple of months since July. And hopefully we can continue it into the close of the year. But if you guys are interested in what we do here, then feel free to check it out. Like I said, a lot of the content is free, and some of it is paid. But even the paid stuff, most of it is just $8 for the month, which is an absurd deal. Even one of those trades would have basically given you free access, or would have paid for access for the next decade or so. So I think it's definitely worth your while to go ahead and take a look at that. Other than that, let's go ahead and take a look. We're going to start with the S&P 500. As you can see on the chart, incredible strength coming out of here. We are accelerating past our recent slope or trend, which is pretty impressive. You can see on Monday we gapped up higher. And yes, you could go ahead and say this is based off of some trade news between the U.S. and Mexico and Canada. But the truth is that this is something that was building up for a while. Whether the markets were anticipating that or just using the news as the reason to go higher is really sort of irrelevant when we're looking at the markets through the lens of technical analysis, as all we're really looking at right now is market psychology and what the market is as far as buyers and sellers are thinking and doing, right? And as you can see right now, they are buying. I think it's pretty clear. At this point, it seems as if the S&P 500 has followed suit with what the Nasdaq Composite and the Russell 2000 had done earlier, which is begin to establish a new stage of our rally. You can say that we've spent the first 6 or 7 months of 2018 trading in a broad consolidation range, and I think at this point you can see that we are breaking out and establishing a new range, right? And it's early. You can't really say where the ceiling of that range is going to be, but we're establishing a foothold above and beyond the previous range, right? And I think for the most part, even though this was inside the established range, I think that the last month and a half, 2 months of price action was a good hint that maybe this was coming. And again, I think the bigger hint was the fact that the Nasdaq Composite and the Russell 2000 had already broken out and established price action above the range, which we'll get to in a second when we go over their charts as well. And so overall, this is a very bullish implication here, showing that the market is ready to move on and ready to continue and start branching out in a higher path, and that the lows that we experienced in the first quarter of the year are really way in the rearview mirror. Now, they've been in the rearview mirror for a while. As you can see, once we established a second bottom here in April, we started forming a nice ascending trend, showing the sentiment had shifted and had started to look upwards again, right? And you can see between the green trend line and this yellow one on the bottom here that we started climbing our way back up and started exploring higher prices and making our way back to the top of the range. And then over the last 3 or 4 days, we broke out to new highs and now are in the process of trying to figure out where our next base is going to be, where our next consolidation range is going to be. Now, as we said in the opening, the risk and reward here is not great, right? This is not a good spot to start looking to trade a lot. I'm not looking at going over aggressive trading right now. I'm still trading. I'm still finding names. But the names aren't quite as extensive as what we saw maybe 2 or 3 weeks ago when we were trading down here in the 280s. At this point, most of the good trades have already sort of left behind, and a lot of the names that haven't broken out yet are lagging for a reason, and so it's become a little bit more difficult to find these gems in the rough, like BIB, like Biogen, which we found just a couple days ago. But it's becoming a little bit tougher to find names like that. And more often than not, what you're finding are names that are at support or not moving because there's really not a lot of demand for them, right? And so at this point, we are at a spot where it's more likely that we need to be patient and wait for consolidation range, and then from there figure out what we want to do. Now, because of the strength and the way that the price action is sort of resolved, more likely than not that consolidation is going to take form as a bull flag. And then we're going to have to play the momentum if we want to continue to the upside. If you're a more cautious trader, someone that likes to buy value, likes to buy support, you might have to be sitting on your hands for another couple of weeks while you wait for a nice pattern to develop. And I think ideally what we're looking at, and this is actually a video I posted on, I believe, Monday or Tuesday, was on some names that broke out. And at this point, what we're waiting for is a retest of those breakouts, right? So at this point, if you're a more conservative trader, if you like to buy value, you're not someone that likes to buy breakouts, you don't like to buy momentum, then what you want to see is eventually we pull back off of these moves and we set up a consolidation range. And at this point, what we'd be looking for would be a retest of 286. Now, it doesn't always come down and retest 286. A lot of times you only get a retest down here, maybe to 289, to the gap. It really just depends where the buyers step in. The stronger it is, the shorter and quicker the consolidation range is, and that's when you end up getting a bull flag instead of a more extended one. Now, again, if you don't trust a bull flag, then just keep waiting, and just wait until it sets up a bigger consolidation range, whether it's there, whether it's up here, whatever it ends up being. But the point is that you need to understand what it is you like to trade, and then you want to wait for the price action to develop in a manner that will give you the setups that you are looking for. If not, then you need to adjust to the market, and you need to trade the setups that the market's providing. And again, that's why we meet every Wednesday, is to try to understand what environment we're in and what setups the market looks like it's going to provide. And my feeling right now is that the market is most likely going to provide us some momentum plays, which means we need to be watching for bull flags or for trades that are just still building up pressure and trying to follow and break out, even if they're lagging behind by a couple of weeks. Now, let's look at an alternative scenario, and I think not a very likely one, but one we want to be prepared for just in case it happens, and that is that the market is starting to get pretty overbought, and there's always the chance that this is sort of a blow-off top. And I don't mean top as in market top. I mean short-term, that we need to that we lose our momentum. I don't think that's necessarily the case. A lot of times when you have sort of one of these exhaustion moves, it happens on big volume, right? The breakout on big volume at the end of a move, that's not really what's happening. At the same point, we are sort of pushing higher with volume decreasing, right? Which is showing them it's starting to get tired. Now, typically, that resolves in a more of a steady pullback than a big sharp drop, right? A lot of times the sharp drops happen when you have a huge volume increase as you accelerate a trend and sort of culminating at the very end of a trend, right? And that's not really what's happening here. So I don't think that's the likely scenario, but there always is the possibility that this turns into a false breakout. Maybe Trump goes ahead and decides to say something that irritates our neighbors to the north and south, and they decide to go ahead and put the trade talks back on hold, and the market doesn't like it, and we sell off. And so if that happens, what are we looking at as far as the levels that we're concerned with, right? As you can see, we did have a rising wedge that we have also accelerated above. So I think in general, this idea that the market's starting to get overbought and stretched out to the upside is valid. The question is, if we do end up with a false breakout, where would we fall? And I think clearly the first level we'd want to watch is 286, and that would be the spot that we're looking at on a healthy pullback. Now, if for whatever reason selling does start to really extend and start to accelerate beyond that, well, then I think that this 280 area is a massive zone of support. And if the markets were to fall back to that area, I'd be looking at buying pretty strongly. Now, again, I wouldn't buy as soon as we touch that area. I'd want to see confirmation. I'd want to see hammer candles. I'd want to see bullish engulfing candles like this one here on August 2nd or the hammer on August 15th. And then from there, I'd look at the constructive action the next or following day as signs of a possible bounce. And then from there, look at entering names in this area. But this is an area I'd be very excited about buying the dip. Again, that's a less likely scenario, but one that I am going to be ready for if it does occur. I think the more likely scenario, again, is that we get a bull flag here. We try to stay and maintain this green trend line, which, again, in the long term is very impressive. If we go ahead and look at the weekly chart of the S&P 500, and you can see we lost that green trend line. That green trend line was signifying a huge rally and a nice bull trend that started at the very end of 2016 and went through all of 2017. And then this year we had a lot of volume, a lot of volatility kick in, and we kind of broke that trend and started consolidating sideways. Now, the market has done a good job of trying to maintain that trajectory, even if it's sort of downshifted gears and was trading just below it, right? And we're trying to get back above and into that range, which I think is not going to, in the long run, not sustainable to maintain this trajectory for much further. But as we get to the Dow Jones, you'll see that the Dow Jones has actually maintained that trajectory throughout this year, even when the other broader markets have been trading sideways. So I think in general, we could say that our trend is still up, and it looks like the market is actually trying to continue to extend this trend as long as possible. So even if we do pull back here, and even if we downshift, I think overall the overall trend is up, and I think that's the one key takeaway that we should be leaving today's meeting with, is this idea that the market is still up, and even if we pull back, your thought process should be one of buying names. It should be one of trading to the upside. It shouldn't be one of looking to short or looking to call a top. Or to try to get out of this market. I don't think that the market is at a point now where we need to worry about its long-term health. Short term, we can be looking for pullbacks every now and then, but long term, things are looking good. If anything, they're looking much better now than they were just 2 or 3 weeks ago when we were still stuck in a range in a couple of these indices. So overall, again, all we're doing now is waiting for better setups more than anything. I don't think that other than that, the market is very strong, and we really don't need to be concerned with where we go if we pull back. Now, here's a look at the NASDAQ, and very strong, very nice breakout, and followed the small caps and the S&P 500 to new highs a few days ago. This is one that we looked at very closely last Wednesday. This was one that we looked at when we put out our free video about Microsoft, Google, and Facebook and whether they were going to bounce. And a lot of it had to do with the pattern we were seeing on the Qs and whether they were ready to sort of break out of this little convergence of trend lines. And again, there's a couple of new people in here, and I want to welcome you again for joining. Thank you. It's nice to see some new traders finding us, whether it's through Twitter or wherever you guys got the link for this. But what I usually point out with this is when we're looking at trend lines like this, we're not just connecting dots on a chart and saying, well, look at this. This trend line's up, this trend line's down. We got to break the trend line. These trend lines are pictures of what traders are thinking, right? And that's the reason that we draw a trend line. That's what a moving average represents. It's not a picture of what the Q's ETF is doing. It's a picture of what people think. And what how they're trading the NASDAQ composite or the Qs, right? So this really short trend line that's descending is telling us that in the short term, traders were starting to get a little bit bearish, but in the intermediate term, which is this trend line here, trader sentiment was still bullish and traders were still expecting price to rise. And obviously in the long term, traders were still expecting price to rise, right? So we had this convergence, and overall, the bullish sentiment won out, right? The rising moving averages, the intermediate trend line, they all won out over the short-term trend, as typically happens. And we broke out. Now, for those that recall, when we were talking about the S&P 500, we had mentioned that the NASDAQ, along with IWM, had already established that they were outside of the broad range we were consolidating to start the year. If you take a look at what we did to start the year, for the most part, you could draw this nice rectangle and say that the NASDAQ was trading between about 171 and, let's say, 154 for the first 5-6 months of the year, right? And then we established a new range, and we've been thoroughly establishing a new range and a new uptrend over the last couple of months, ever since really June. And we're still in the process of exploring where the ceiling for that range is. You can see that this trend line, intermediate trend line, is pretty strong. Not that one, that's the short term. And since we bottomed out in the middle or late June, we've done a good job of climbing higher. and we are still in the process of, again, exploring where the top of that range is. You can, if you want, go ahead and extrapolate and put the top of that channel there. And according to that, we still have a little bit of room to go ahead and try to explore above this level, right? And so I think overall, as you can see, the candles are expanding, showing that volume or that price action is increasing in speed and is still gaining strength, right? Typically, when you have a move like this, what happens next is a bull flag and then a continuation, right? So overall, again, this looks very healthy, and there's nothing negative I can say about it. Again, pointing out Microsoft doing really well, Google doing really well, Amazon doing well, Apple doing really well, and there's only one of the FANG stocks that's not really doing well, and that's Facebook. But everything else is doing very, very well, and even Facebook is being pretty constructive with what it's doing. So it looks like big tech is coming back. It didn't really go anywhere. It did. We had a couple of poor earnings reports last quarter and a couple of the bigger names, but overall, some of the big tech names had stalled out, waiting for price to rotate back into it, and it looks like it's starting to rotate back in, with a lot of those names exploring new highs along with the Qs. So I think overall, again, this is a picture of strength. If anything, maybe this and IWM, I'm not sure, it's hard to say, but I think the Qs might even be the best picture of strength in the markets right now. Again, if we go and take a look at the weekly chart, and there's nothing here to be nervous about. There's nothing to really worry about. This looks like the first half of this year. It mimics what we saw throughout 2015, but you'll notice that in 2015, this was actually a consolidation range that took almost 2 years to resolve itself. And this year, our consolidation range looked like it took about 6 months, right? So it looks like this rally still has more legs. When you have these nice consolidation ranges, this is a nice way to build up more steam to continue breaking out. So overall, I think there's still legs to this rally. I think that we still have room to the upside. And it's the same thing that we pointed out before with the S&P 500. At this point, you don't really want to buy something that's mimicking the Qs right now at highs, right? It's up 1, 2, 3, 4, 5, 6. Out of the last 6 days, we've got one little red doji that even that day closed above the previous day. Chances are, at some point, it's going to pull back. And at this point, price is too extended to just go ahead and try to chase higher. But we're still in a spot where if we get a pullback, then we want to go ahead and get involved in it, right? And I think that this is reminiscent of the chart I pointed out a little earlier, HCP, where you can see it just every pullback, you just continue to buy it as it starts to climb higher, right? And that's really what the NASDAQ is doing. And it's been doing actually since June. So we'll continue to follow this. The alternate scenario, again, if we were to have a lot of selling pressure come in, where would we go? Well, I expect 178 to be the first level of support if we lost this trend line. And more importantly, this is a major level at 171. I do not expect us to reach this anytime soon. This is likely more than a month away, and even then, more likely several months away. But worst case scenario, if we did really start to sell and really increase our selling pressure, we'd probably stall out at 178 for a bit, and then eventually we'd come down and test 171. And that would be a major area of support, and one that I would be looking at buying quite a bit. Now, again, I don't think that's anything that we see in the cards anytime soon, but I do want to point out alternative scenarios in case, for whatever reason, news comes out of left field and really scares the markets. Then this is the area that I will be looking at with a lot of anticipation whenever it does occur. Now, again, that may not happen for a while, but I will be prepared if it does. But the more likely scenario is that if we do pull back, we likely don't lose this trend line, at least on the next pullback. And if we do lose that trend line, we probably don't lose this 178 area, which again, more than anything, points out the underlying strength that we're seeing in the markets and the fact that it's going to be hard for the sellers and the bears to make any kind of an impact right now on the overall markets. We go ahead and take a look at the Dow Jones. Lana, we will take a look at GC. That's gold, right? We'll take a look at gold. We always look at gold, but we'll look at that chart if you want. All right. Here's a look at the Dow Jones, and very similar to these other indices. It's sort of testing the top of its sort of channel. Now, unlike the S&P 500 that sort of accelerated past that channel, and the NASDAQ, the NASDAQ's kind of approaching that channel, but it's doing so at new all-time highs. The Dow Jones is still short of all-time highs, and still really hasn't broken out of the intermediate channel. That's relatively weak in the short to intermediate term. However, the Dow Jones continues to show, or continues to kind of take advantage of the relative strength that it had in the long term. It was so strong earlier this year, and it got so far above this trend line that this entire correction has taken place within respect to the long-term trend. And other than a couple of weeks where it threatened at breaking below this big green trend line, it has mostly sort of respected its long-term trend and continue to kind of climb with respect to it. So this is actually, ironically, a relatively weak and strong name at the same time, depending on what trend or what time frame you're looking at. And I think overall, more than anything, and this is something we've discussed quite a bit, is that this is really probably more due to money rotating to riskier assets, because it feels more safe in doing so. And so the money is flowing towards the names that are more volatile and can provide better returns more than anything else. And typically, when it flocks back into the Dow Jones, it's when it's worried about selling pressure. So what happens sometimes is if money is worried but wants to be invested, it'll flow into the Dow Jones and out of, say, the small caps of IWM, right? And that's what happened earlier in the year, and that's what happened last year towards the later stages when anytime there was any kind of selling pressure, the first place that traders would sell would be the small caps, and they'd flock into the Dow Jones, and that's why the Dow Jones did so well, because it wouldn't sell off, it would only go up. And at this point, a lot of traders maybe have moved their money from some of these safer names to some of the riskier assets in IWM, which is why IWM has done so well recently as well. And that shows more than anything buying conviction, right? It shows that traders are willing to assume risk and they're willing to stay in the riskier names, whilst maybe ignoring some of the safer names that they tend to go back to when they're worried about the market. So overall, the fact that the Dow Jones has lagged for most of the year hasn't really been worrying for us. And I think, again, it's not anything I'm worried about. But I am happy to see that it did a very good job and a very constructive behavior once it established itself back above 250 in July, and then has been able to explore the upper half of this range, right? So this is the range that it's been in all year. As you can see, unlike the other indices that have already sort of established new price ranges above the previous one, the Dow Jones is really just exploring the second or the upper half of it, right? And so there's still work to be done on the Dow Jones to print new all-time highs. But overall, I'm happy with what it's doing, and I'm not really that concerned with it printing new highs yet because the other indices have all done so well. Now, again, at this point, it's pretty overextended and or overbought, and what we're looking for right now is a bull flag or a pullback to retest the bottom of this channel. And that's really what we're looking for, is just for price consolidation to give us better risk reward. And then from there we can move forward. All right. Finally, we have IWM. Now, again, the small caps broken out to new highs. A couple of weeks ago, they were the one index that actually looked like it was starting to come up into overhead resistance, while all three other indices were testing support. And it was an interesting sort of conflict here to see which would have won out. And then when IWM broke out, I think that was a clear signal that the rest of the markets were going to follow suit and break to new highs. And that's been what's happened so far, and that's been the case. And the same as the other indices, there is nothing negative I could say about this, other than it's overbought and the risk reward's not great. We're climbing higher. Now, granted, this is a nice tight channel that typically doesn't last very long. What we'd like to see here is a shift to a bull flag, which is already starting to occur on the small caps. And then from there, you can go ahead and maybe buy once you get another 2 or 3 days of consolidation. But that might not happen. When there's this kind of strength, sometimes it just continues climbing. And I think the big key right now is, from a psychological standpoint, we want to be patient. Some of you guys know, those of you, maybe some of you that new don't know this, but I also trade extensively in the cryptocurrency space, right? And cryptocurrency traders have an acronym they love to use called FOMO, fear of missing out, right? And of course, fear of missing out is not some sort of new psychological problem or cognitive issue that traders recently had or only have with cryptocurrencies. It's something, obviously fear of missing out, fear of missing a trade is plagued traders ever since trading existed, right? But it's an acronym that they love to throw out and use. And I think it's in many ways a more insidious and difficult fear rather than the fear of loss. You would think losing your money is the most important fear, or the strongest fear that a trader has. But the truth of the matter is that the more damaging fear is fear of missing out. More often than not, traders get into trouble because they chase trades or they jump into trades early because they're worried about missing out on a move, right? And I think that's the biggest problem we have in the market right now, is that this kind of action lends itself to making traders, having traders make mistakes because they don't want to miss out on a trade. Now, it's not necessarily on IWM. It could be on say, Apple, right, where it's just gone up so many days in a row, and you can see it keeps going up. And what's happening here is traders keep chasing the price action higher because they're worried about missing out on this move, right? If they missed it on that first gap up, then they keep chasing higher because they're worried that they're going to miss out on this move, right? And more often than not, what ends up happening is the traders that keep chasing this price action, eventually you get a pullback, which is normal and healthy and part of normal price action where shares are going to exchange hands between buyers and sellers constantly. They're going to sell out as soon as it drops, and they're going to say, oh, I can't believe this happened to me. And the truth is that they put themselves in that position by chasing the price action higher. And the more patient traders that waited to buy at a good value are going to be the ones that take it right off their hands and then get to ride it on the next wave up, right? And this is the only real problem we have with the market right now in the short term, if we're just looking at it and analyzing it, is that it's set up in a position right now where the risk reward is not great, right? So we need to be patient and wait for better opportunities that we had, 2 weeks ago, right? And 2 weeks ago, we were talking about the fact that there's a buying opportunity coming if the price action shifted in the right direction, which it did. At this point, we need to be patient and we need to wait for clear opportunities that give us better risk reward, right? And that's kind of where we stand. Now, same as what I mentioned with the other indices, if we do have a pullback, if we do start to sell off, well, where do we want to buy on IWM, right? And I think in the short term, it's pretty obvious. This 169 to 168 area where we broke out is a really key area. I don't think that this trend line here is one that's going to sustain itself too much longer and one that we need to really use as a buying area. I think if we do pull back, ideally a retest of 170 is what we'd want to see, right? This is the most healthy scenario for anyone that wants to buy value or support. This is the most the ideal one would be just to pull back to retest a breakout and then a continue move higher. If we do have a bigger pullback, right, something like that, well, what are we looking at? Well, we're looking at the moving averages down here, 168, and then below that, we're looking at a zone here. Now, it's going to be a little bit more tricky with IWM because it didn't really establish a horizontal level of support. If anything, what we'd have is this intermediate trend, which would act as the next level of support. And that would be sort of the intermediate term level of support. And that, again, would be just below the moving averages. And then finally, way down here, 162 to 160. And then that would be major, major support. And again, I would be anticipating a lot of buying orders coming in if we ever hit that level, or when we hit that level again, which might not be for quite a while. But it is something to keep in mind. If for whatever reason a lot of selling pressure comes into the markets, you don't want to totally panic and freak out. You want to be using these areas as levels to look at as major buying support. And again, big reason for that is this was the range that we consolidated for the first half of the year, and it's now the top of that is now the bottom of the range that we're establishing this year, right? So more often than not, what happens is when you come down to those ranges, they hold. And that's where a lot of value buyers are waiting to go ahead and step in. So that's the four major markets. We spent a little bit of extra time on it today, but wanted to make sure that you guys understood where we were and what the big issues right now with trading are. And more likely than not, any issues we have are not with the market. It's with our own personal psychology and with making sure that we understand what our advantages are in trading. And that's being able to control our risk and our reward. Not obviously, we can't control whether stock goes up or down, so we have to make sure that we are entering setups that give us the best probability of success. Real quick, we're going to look at the U.S. dollar. We'll look at gold and silver, and then if anyone else has a chart request, I'd love to see what you guys are looking at. GC will be a regular part of what we're looking at anyway because it's going to be gold. But once we're done with that, I'd love to see if you guys have any charts. All right, so here's the U.S. dollar index. You can see the U.S. dollar has been pretty weak recently with a pretty big drop-off on the index. Now, it is coming up into some support here, and I would expect buying or strength to come back into the U.S. dollar over the next couple of weeks as we explore these support areas. You can see we tried to bounce yesterday and are failing today, but I don't expect this move to continue downward too much further. At this point, we need to explore this area before maybe we get a resumption of the downtrend. If we look at the euro versus the U.S. dollar, and again, this is going to be inverse, right? The euro, because this chart's priced in euros, up is good for the euro and bad for the U.S. dollar, right? And you can see the U.S. dollar, again, has been struggling versus the euro, but it's coming up against a pretty important area. This is the last time that the euro tried to bounce against the U.S. dollar. It failed, right? And you can see we're starting to encounter some pressure here. And I'd expect some consolidation in this area between 117 and about 116. So if any of you guys are Forex traders and you've been trying to trade this euro bounce, this is a good spot to start looking at taking some profits and start looking at the U.S. dollar. Maybe I don't think I'd go long the U.S. dollar here or short the euro because more than anything, this is going to likely resolve into a consolidation and just sideways action. But at this point, I think that this move is starting to get a little long in the tooth, and this is a point where you want to start taking some profits if you were in this. Now, if we look at the U.S. versus the Canadian, and you can see the U.S. dollar has also lost strength. Now, again, this one's back in U.S. dollars, right? So down means bad for the U.S. dollar. And we're still kind of in this channel. And we're back to the bottom of that channel, which, again, means that more likely than not, we should find some support here and start to bounce and start to maybe try to make our way back up to the top of this channel. So the same picture as the UUP index, which is the dollar has been weak, but is likely coming into some support. And then finally, the U.S. versus the yen. And now this one's been interesting because the U.S. dollar has actually picked up strength versus the yen, despite the fact that it's weakening, which again probably shows more than anything weakness incoming on the yen rather than U.S. dollar strength. But the U.S. dollar has gained strength versus it, and interestingly enough, is starting to get above a key level here, which is the middle of this broader range of between 115 and about 107, and probably is going to stall out here as well. So I'd say more than anything, the big thing we could take out of this is the U.S. dollar more than anything is probably going to stall out and trade sideways. Okay, and what does that mean? That means that the likely scenario here is that gold and silver are going to stall out and trade sideways as well. All right, so here's GLD first, right? And you can see GLD had a nice bounce. Those of you that are regulars know I am not interested in this bounce. on gold, on silver, and the reason for that is because they are below major levels of support. Right. So any bounce like this is destined to be short-lived as it comes up and starts bumping its head against a major ceiling of resistance up here. If we go ahead and take a look at gold futures. And you're going to see the same chart basically, right? But if you want to look at these levels now, the data is delayed on this, but it's the same basic idea here, right? This is the weekly chart, and we're actually trying to maintain a foothold here, which is it's nice. It's a little bit different than the ETF. Sometimes these ETFs, over the long run, they have a little bit of extra decay because of contango, because of the cost associated with running the ETF. Keith, I believe there are options on UUP, but they're not worth your time. I'll get into that in a second. Once we cover gold and silver, we'll go back to UUP and the options on it and why I think it's not a good idea. Okay. All right. So if we look at this, you can see gold, as far as the futures contract is concerned, is actually still trading in a range, right? And actually, this is a little bit more appealing than what I'm seeing on the GLD on the ETF, right? Because we actually have some support here, and maybe can make our way back up a little bit. But we did break down below it, and again, that's the weekly chart. We go to the daily. You see what's been going on here. Well, Lana, the futures chart itself is actually holding above resistance and is a little bit more appealing to me than what I was seeing on GLD. However, I'm still not that excited about it. And the reason I'm not that excited about it is because I think the dollar is still going to sort of trade sideways. Now, if the dollar resumes a downtrend, then this actually looks a little bit more appealing as a bounce play because it is at the bottom. Now, do you actually trade the futures, Lana? Or are you thinking about trading the futures on this? And if you are, what kind of time frame are you looking at? Are you looking at this as a day trade? Because obviously, usually when we look at gold and silver, we're looking at it as far as longer term action. So if you're looking at it from a day trade perspective, then we can hone in our focus a little bit and look at it on the shorter time frames. But it is nice to see the longer term time frame. So now that we established that this is actually a pretty key area, 1211, 1205, that's a huge long term area, right? So as we drill down, we can see that that's a good spot to go ahead and play as far as buying. Now, when you're trading these in the short term, okay, if you're looking at it for a longer time, I think the margin on this is pretty rough to hold overnight and to hold for extended amounts of time. But if that's something that's fine with you, then cool. If you're looking to hold it on the longer time, understand that a contract like this, there's still a lot of downward pressure on gold and silver, and there is a potential for a serious move to the downside in this. And so keep that in mind if you are doing something like holding a gold futures contract. Okay. Now, as far as the short term, a lot of times what you could do when you're day trading or when you're trading futures is you want to establish a blueprint of what is possible and what is likely to happen over the course of the next week. And then from there, you can go ahead and start trading the key levels, right? So now that we've established in the long term what a support level is, and even in the intermediate term, we have a pretty good picture of what the intermediate term trend line or sentiment is, right? And we even have another trend line we could draw right around here, which kind of divides this area between two, right? You can see it was attempted to support at 1220, and then it turned into resistance at 1220, and then we fell, and then the last time we came up, it was 1220 again was a pretty key level. So we now have key areas that if we drill down and trade off, say, a 15 or 30-minute chart, we have areas that we can look at as far as where we want to buy and sell the GC if we're trading this day trading or even trading just over a couple of days, right? And so now we know. And now as we drill into short term, you can see we've got a nice little channel here. It's at the top of the channel or pretty close, so this is not really a good spot to buy. But this is a good spot where you might want to start looking at, if you're just going to day trade, you might want to start looking at either shorting it or waiting for a pullback and then playing it again to the upside if you want to just play the trend, right? And so we've got some levels now that we want to watch. So if you're looking to day trade this tomorrow, Friday, these are the areas we want to watch. You want to watch 1208, which it probably doesn't get back to. It's probably going to continue to respect this trend line for a little bit further, and then this 1213 is going to be a key level. And more importantly, as we start to approach that descending trend line on the daily chart around 1218, 1219, that's going to be a big selling zone and a big area to look at as far as if you're trying to trade long over the course of a couple of days, where you'd want to go. Okay, so that's GC, which again is piggybacking off of what we're seeing on GLD, right? I'm going to get rid of some of these trend lines just so I don't have them next time I look at the chart. But if you were day trading this, or if you want to day trade this, you'd probably want to leave some of these as blueprints of where this is likely to go in the next couple of days. Okay. All right. So here's SLV, and SLV again looks terrible. We could look at SI as well. And this one, even on the futures, has clearly lost a major level here. Actually, this looks just like SLV, so we'll go back to piggyback my previous trend lines. And I'm not interested in buying this. Yes, it could bounce. And this is the same reason that I'm really not that interested in gold, right? Even if the GC chart looked better, when we break these key levels of support, it's so much harder to get back above them, right? And it's going to be the same case with silver. Now, GC didn't quite lose that level yet, but it's pretty close to. But SLV, again, well below it. SI was well below it. And at this point, yes, it could bounce, but there are better names. There are better areas that I could find to trade rather than trying to catch these. I did like these in the long term quite a bit just a couple of weeks ago or a couple of months ago as they were establishing what looked like the beginnings of a new uptrend, but that failed. And at this point, we need to kind of sort of reevaluate where we stand and where these can go. And for me to really want to get excited about SLV in particular, it needs to be back above 1450 at the very least, and maybe even 15 before I really want to go ahead and get involved. And finally, we have oil. And oil, as we spoke of last week, or as we said last week, it looks like it found a nice bottom here and wants to start trying to establish price action above 66 and probably needs to explore a little bit higher. It's sort of getting stalling out a bit here at 69, but I think it's going to make its way back up to maybe the 70, 71 area. I don't want to see it back up at 75, but it looks like it's ready to start establishing more of a sideways price range. And found a bottom here, 64 or so. It looks like a nice short-term bottom. And at this point, it's just sort of consolidating and starting to build up to start making its way back up into the 70s, which is likely going to be the case with oil-related names as well. They're going to be doing a little bit better as they mimic this. All right, so back to, we're going to go with Keith's question, and then Denise will look at CGC yet again, which has done really well recently. All right, so Keith, the reason UUP options are not a good idea. This thing moves 50 cents to $1, right? So when you're looking at options here, it has 50-cent strikes. So even if you use the 25.50 strike, you're spending options, or you're using options to try to get these tiny moves. Then more often than not, what happens is the options decay and lose all their value. When you have a name that moves this little, right, this low beta, the options are not a good choice for it. Now, there are other choices. What are I can't remember right now the ETFs Frank, if you are on, what are the ETFs for the euro? For some reason, I'm drawing a blank right now. On what the ETF is for the euro or for currencies. Well, it looks like Frank is not online, but there are. I don't know why I'm drawing a blank here. I've traded these in the past. There we go. Thank you, Blackhawk. It's the FX ones. FXE, FXC. Thanks, Keith. I've never heard of FCI or whatever. What is that? FC. Yeah, I've never heard of it. It's FXC. Thank you, Blackhawk. I appreciate that. I had a nice brain fart there. I could not remember the ticker for some reason. All right. So if you want to use options for a currency, rather than UUP, you want to do something like this. You want to focus on at least these, and again, I don't think that even these are really that worth it, because even this one is not that volatile. You're looking at $1, $2, $3 a move, but at least like this, you get a little bit more movement in between the strikes than you do with UUP. The problem with UUP again is that it doesn't move. And actually, a few years ago, Frank and I knew this trader that went with an exorbitant amount of options on UUP because he had this, he thought that there was a certain move coming out of the US dollar. And what he ended up doing was just watching all of his money just lose its value, because it would move a quarter at a time. And it just wasn't enough movement for his options to ever get in the money, right? So it really wasn't worth his while. Now, the opposite of that is, well, if it doesn't really move, isn't it worth selling? And I would say yes and no. Yes, in that it's more likely than not that any options you sell on something like UUP are going to expire worthless. No, because you're getting so little for it, and you have to pay commissions that it's really not worth the small risk. Small probability chance that you get a high risk event. Something happens overnight where it one of these black swan type events, and then you try to collect 5 or 10 cents, and it turns into a $2 or $3 loss, right? And so I don't think selling UUP is really that great of an idea, because the returns are so low, even if the probability is really high. And I don't think buying UUP options is a good idea, because the probability of success is pretty low. Because again, it's just such an involatile name that you're not going to really get much out of it, right? So you could try something like FXC, FXC, any of the major currencies, and you could try the options in these. But I think even on these, it's not that great. Now, well, they're inversely correlated, right? Because the euro is basically the major currency that trades against the US dollar, right? So if you look at FXE, and it is going to be the mirror image of UUP, right? You go ahead and you take a look here. I'm going to draw the major, right? So we've got this rising wedge, and we've got this big up and down, right? Well, if you look at the euro, it's the inverse of that, right? You've got here's the big triangle, or the up and down, the V bottom. You've got the triangle, right? You have the big move leading into the triangle, and then the triangle from before. And that is all we did was flip this chart upside down, right? So yeah, they're inversely correlated, and it's because it's really the same. The U.S. dollar, the UUP index, is going to be, more than anything, is going to mirror the euro, because that's the biggest currency that trades against the U.S. dollar. So it's going to be the most weighted on this index. Okay. Now that being said, now if you're asking to trade options on something like this, I'm assuming you're doing it because you want leverage, right? I'm assuming it's not because you want to use some advanced option strategy. It's because you want to trade with leverage, so you put less money up. And if you wanted to do that, I'd say just get into Forex. You could trade Forex with a lot of leverage without having to outlay a lot of capital. Um, and I would that's the easiest way to trade this to get more bang for your buck. One of the reasons that I would never trade something like UUP or FXE, was part of the reason why I even forgot the name FXE, is because I'll just, if I want to trade currencies, I'll just trade the currency. You don't need a lot. You don't need a lot to trade the euro US dollar. You don't need a lot to trade whatever, any of these, whether it's the U.S. Canadian. All you need to do is understand how a PIP works, open up an account with a Forex broker, and you're good to go. Right. And so I think the best case scenario in this situation would just be to open up a Forex account. If you want to stick with stocks, then I think probably FXE, or if there's another ETF for the US dollar, which I'm also forgetting, which Blackhawk will find for me if it's there, you could trade that, right? And I think that's the easiest way of doing it. But UUP is not the one. I think UUP it just doesn't give you enough return for your options. Okay. All right, Denise, let's take a look. Our weekly look at Canopy Growth and what it's doing. And it's doing very well. Now, I had a couple of Twitter conversations on this recently, and someone was saying, well, it's done great now. And I think I mentioned, it looks great. On a pullback would be nice. And he's like, well, where's it pulling back? And the truth is, I don't know where it's pulling back. The big thing we wanted to point out, we looked at this recently, right? And what I was pointing out yesterday was the massive volume that came in on this, right? Which is a huge sign of buying power and accumulation here above 32. And I think at this point, that's going to be the new floor, right? So if you're looking at this, and I know you like this long term, you have it long term, and that's the new floor, right? Just the same as what we looked at with the stock market, right? You've got the previous range, and we've got the new range, and the new range is going to be up here. Now we don't know what the ceiling is. At the moment, the ceiling is 48, but we know the floor is very likely to be 32 to 33. It could possibly even be up here at 30, 35, 36, right? But we know that that's the new floor, and price action is likely to not fall below that level. So anytime it comes down to that level, that should be looked at as a good buying opportunity. You sold some 32.5 puts. I like and dislike that idea at the same time. I like that idea because it's very likely that if it comes down and you get assigned, you just picked up shares at a good spot. I don't like the idea in a certain sense because unless you sold puts back here, you probably didn't get a very good price for it. If you sold puts just in the last 2 or 3 days, that's the wrong time to sell puts. That's the right time to sell calls. You always want to sell calls when you have explosive price action to the upside, and you always want to sell puts when you have strong price action to the downside. Because that's when you get the most inflated value for them, right? You sold 2 weeks ago. All right, so never mind. Great sell. I like it and I like it. There's nothing wrong about there's nothing I can say negative about it. So great job. Worked out well for you, and that's a great job. So you sold right around here, which was the perfect time to take advantage of that price action. Other than that, there's nothing else we can say about this. We've actually covered this quite a bit over the last couple of weeks, and we've gone over all the fundamentals, the possible buyout scenarios, and there's nothing really else left to say other than let's just keep watching it. And if you missed this trade, if anyone didn't and likes it long term, then what you want to do right now, it's the same basic scenario as what we're looking at with the markets, which is we need to wait for a pullback and we need to wait for some support before we could go ahead and try to trade this. And if you're looking at this as a long-term scale-in, then you want to look at the 32 to 34 area, and that's what I mentioned yesterday on Twitter. All right, 1:30. That's pretty much the time we have allotted for today. If someone has one more chart request, we could maybe do one more, and then we can go ahead and finish for the day. If we don't have any more chart requests, then we could be done. I want to thank any of you guys that came in. I appreciate the participation, and All right, Denise, you want to look at bonds. All right, so bonds are, uh, which ones do you want to look at? Long term, short term, TLT? All right, Lana, I'm going to put up in the chat. All right, so for anyone that's still in, that's not already a member or patron, it's patreon.com/stockdarts. And again, a lot of free stuff on there, and a lot of there is some paid content, but it's not really anything that you. I mean, if you $8 for a month is basically free. It's just to sort of weed out and make sure that we're getting participation and interest. All right, here's TLT. I don't really think that there's much going on here. In a lot of sense, this is basically what we're seeing out of the U.S. dollar, which is that we're likely to sort of stall out here. You can see it's going to be pretty much inverse again, and we've had a nice move up to the 122 area, and we're just basically sort of stalling out. I think we're just waiting for interest rate changes more than anything. Let's look at the 10-year, and same thing. I think at this point we're waiting for new news out of the Fed. And again, I'm sure you're looking at this more short term, right? And so we'll zoom in on it a little bit. We'll go back to TLT for that. Because TLT is not delayed, so we got a better picture of it. All right, so here's what I've been watching. We had a rising wedge, right? And we sold off as we approached 122, which was expected, and we gapped down. We're printing little tweezer hammer candles here. Now, when you look at the picture like this, right, the next step, more likely than anything, is that price action will be up for the next couple days, and then it'll probably head south again, right, based off of the way this works. Each time you have a move to the top of the range, you eventually lose it, you come up and you retest, and you lose it again, right? It happens quite often. You get the move to the top of the range, you lose it, you try to test it, you fall, right? And that looks like what's happening again. Is the same basic idea. We lost the range, came down, try to make one more chance at it, and then fail. Now, the one thing that can be different this time is that you can see strength is picking up and then we're getting higher lows, right? So there's always the chance that this changes, and instead what we get is something like this. I probably should have just left that descending trend line. Just done it like this, but it could be that we get something like this and then another attempt at highs, but it'll be pretty obvious if it changes course and tries to do something like that. But I think the more likely scenario is we will bounce, and then we will likely drop. And then from there, the question is, do we drop all the way down to 119, or do we drop temporarily back to the moving averages and then try to make our way up? But it looks like what's happening here is price action is starting to contract here, likely due to the expectation of interest rates changing in the next couple of months, right? And so, again, these are very slow moving and tend to play out over the course of months. These moves don't typically play out over the course of days. Would it be ideal to sell a call credit spread at 121? I think it would be ideal to sell a credit spread at 122 to 123. I would not play the game of trying to do 121. I think that's too close to price action and inside its range. There's a pretty good chance that price could end up here. I think there's a much lower chance that price ends up here, right? So I think ideally, now I don't know the prices on the options here, so it could be that we're too far away for this to be worth your while. But this is where I'd want to sell a call credit spread. So what ideally, Keith, if you're interested in a trade like that, I'd want to see price bounce for another day or two. And as we start to approach the 122 area, then I'd look at 122.50 to 123, 124, and that range. And I think that would be the ideal scenario, because more likely than not, that's going to be a ceiling. That's been a ceiling for basically all of 2018, right? And more likely than not, that's going to continue, at least in the short term. So that would be where I'd be looking. I think 121 is aggressive. It could work out. It could be that we do come back down, but I think considering we've got two hammers here, there's a pretty good chance we're going to try to make our way into 121. So I'd be much more interested in this area. I think this is a much more defined area to look at as selling a call spread. Okay. All right, guys, that covers it for today. I hope that helped, Lana, and I hope, Keith, that helped as well. Just in general, my advice on trading and how sometimes, even if you have a good read on a chart, if the instrument doesn't provide you with a good trading opportunity, you have to ignore it. And that's something that we get that a lot during my earnings workshop, right? Where I'll see there's a particular trade that looks really good, but we just don't get the risk reward because the options don't have enough value. And that's a really important question you have to answer or ask yourself every time you look at a trade is, even though you might have the right read on the chart, are the instruments that you're using giving you the right opportunity to trade, right? Are they giving you good enough risk and reward to go ahead and take that, okay? All right, have a good rest of today, guys. I will put the recording up on my Patreon page later today, and we will see each other again next week.